What are futures contracts? How are they traded? What are futures contracts used for, and what are some of their different types? For the answers to all these questions and more, keep watching. Hi, I'm Oliver from the TabTrader Academy, and today we're going to be looking into the definition of futures markets. On futures markets, participants exchange assets for delivery on a predetermined date at a specified price. The buyer and seller agree on the price and amount of the underlying asset at the time of the trade, but actual delivery comes later. Futures are most commonly used by traders for risk management, also known as hedging, and speculation. Hedging is an investment strategy which aims to reduce losses potentially resulting from unfavorable price action. By locking in the asset's future value, traders help mitigate the potential risks of costs later on. Speculators trade futures contracts in an attempt to profit from fluctuations in the underlying asset price. They bid on the direction of the underlying asset price movement and profit in the event that it goes in their favor. Now that we know what futures contracts are and why traders use them, let's take a look at how to trade futures contracts. Futures contracts are most commonly traded with leverage. In leverage trading, a trader borrows funds from a broker or an exchange in order to increase the size of their exposure to an asset. A trader takes on a position greater than their capital allows, but in return gets the opportunity to multiply their gains from the investment. Now let's take a look at a variation of futures contracts called options on futures. Options are a kind of derivative contract which represent the right rather than the obligation to buy or sell the underlying asset. Options trading is considered more safe than futures trading. The maximum risk a trader is subjected to while trading options contracts is the loss of the premium, which is the price of the options contract. Based on the kind of underlying asset, futures can be divided into various categories. For example, financial futures, stocks futures, currency futures, and also, of course, cryptocurrency futures. Financial futures include interest rate futures and index futures contracts. Interest rate futures are a kind of financial derivative that locks in the value of an interest-bearing asset. Index contracts allow investors to place a bid on the general direction of price movement of various stocks. Crypto futures allow traders to buy and sell cryptocurrencies on a predetermined future date. To wrap up this episode, let's go over some of the pros and cons of futures contracts. On the plus side, futures contracts are an easy way to speculate on the underlying price movement of an asset. They also serve as protection against market volatility. Futures contracts are also traded with leverage, which allows investors to increase their exposure to an asset and also potentially multiply their gains. However, leverage also subjects investors to higher losses in the event of unfavorable price action. And of course, in futures trading, the contracted price of an asset may become less favorable as the expiry date approaches. And that's it. Now you know what futures contracts are and how they're traded. As always, please leave us a comment down below with any feedback or questions you may have, and we'll get right back to you. And on that note, don't forget to subscribe to TabTrader's YouTube channel and follow us on social media, and the links for that are down below. And of course, if you haven't already done so, give crypto trading a try with the TabTrader app.